What are stock options, and why should you care? Welcome! Today we are demystifying an investment topic, stock options. By the end of this video, you will get a basic understanding of what stock options are, and how they could benefit your investments. Disclaimer: this video only covers American options, and is for purely educational and entertainment purposes. None of this is financial advice. Before we talk about stock options, let's talk about stocks quickly. A stock represents ownership in a company. When you buy a company's stock, you are a part owner of that company. Similar to stocks, you can buy and sell options in the exact same way. The difference is what options represent. Think of options like an early access ticket on the stock. It is a contract giving you the right to buy or sell a company's stock in the future. Stocks and stock options are types of investment vehicles. People buy stocks for various reasons. They could believe in the company's mission, or maybe they believe the company is undervalued. The simple truth is that they want a profit from buying the stock because they think it will be worth more in the future. Well, the same is true with options. Options are just another type of investments that can make you money. Traditionally, options are used as an insurance policy. Imagine that you own stock in company ABC, but you aren't entirely convinced that it will do well. Now, as the smart investor that you are, you decide to buy a put option, which protects you in case company ABC stock starts falling. What is becoming more common is that options themselves are bought and sold as investments, similar to buying and selling stocks. While options are more risky, options can be even more profitable than stocks with their inherent leverage. Let's take a closer look at options. There are two types of options that you can buy and sell. Call options are contracts that let the owner buy stock of a company at a specific price in the future. Put options let the owner sell stock of a company at a specific price in the future. Keep in mind, it is not necessary to have any stock in the company to buy or sell their options. An option contract has four key parts: the stock ticker, the expiration date, the type, call or put, and the strike price. Here, company ABC stock is the ticker. December 27, 2024 is the expiration. After the expiration, this option becomes invalid or worthless. This is a call option, with a strike of $100, meaning that at any time before December 27, 2024, the owner can use this option to buy 100 shares of ABC at $100 each. Here is another example. This option is for company XYZ expiring on January 31, 2025. This is a put option, which allows the owner to sell 100 stock of XYZ at $27.50 each before or on January 31, 2025. By now, you are probably thinking, so what? It is important to know that buying an option isn't free, but it is usually cheaper than buying stock. But let's get to the point. How do you make money with options? We will take a look at an example with company XYZ. We are buying call options on company XYZ, which is trading on the stock market at $1 today. The options expire in 1 year, and the strike price is $2. The options themselves cost 10 cents per share, or $10 per contract, because options always come in bundles of 100 shares. This means that for you to make money, the stock of XYZ must reach above $2.10 within 1 year. Let's assume that you bought 100 shares of XYZ at $1 per share, or $100 total. In 1 year, the shares of XYZ increases to $3, and your shares are now worth $300 total. In 1 year, you have made $200 profit, or plus 200% returns on a $100 investment. That's pretty good. Let's look at the call option scenario. Instead of buying XYZ stock, you decide to buy the call option on XYZ at a strike price of $2 for 10 cents per share, or $10 total. Keep in mind, one contract always comes in a bundle representing 100 shares. After 1 year, company XYZ stock goes from $1 to $3. Your call option is now worth $1 per share, or $100 total, because that is the difference between the market price of XYZ stock and your strike price. On a $10 investment, you have now made $90 profit or plus 900% return. Since you had $100 originally to buy the stock, you could have bought 10 of these call options and made $900 in profits instead. So far we have only talked about buying call options. As an investor, you can also sell call options and buy or sell put options. The profit and loss profile of each of these different strategies is different and is too much to discuss in one video, so just understand this. When you buy an option, you incur an upfront cost with potential increasing returns. When you sell an option, you receive an upfront payment but with the risk of increasing losses. Now that you have learned a little more about options, hopefully you understand their potential to be even more profitable than stocks. However, remember that company XYZ example from earlier? Well, if the stock price of XYZ never reaches above $2.10 in a year's time, then you would have lost money buying the call option. If you had bought stock instead, you may have kept your money and even made a little more. So options are not without risk. Options are not without risk, but despite their simplicity, investors can use them to perform advanced investment strategies. Remember, you can buy or sell options at any time before their expiration date, just like stocks, so the profits and risks are all in your hands. Hopefully this video has made you a little more aware of the benefits and risks of options, and more comfortable in engaging with this type of investment. There's lots more to learn about this topic, and we will have more videos in the future.